Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video I am going to talk about how do you know when it's time to close your covered call trade, whatever that is, and take your profit. And if you watch my videos, as you know, US Steel, ticker symbol X, is my main holding. And if you own shares of steel, or if you're long steel in some way, then you had a very good day Friday, as I did. My account is back over $32,000. I made almost $400 in a single day because steel went up a lot due to the earnings report that was better than expected. So in this video, as always, I am going to start out by talking about my money and what I have been doing. So here's the transactions right here, and I'm going to go back to September, and I'm going to talk about a covered call trade that I made all the way back from September the 9th, and I bought 200 shares of steel at $11.97 a share, and I put it all into the PowerPoint here so it's easy to see, and I'm going to zoom it up. So all those little arrows is all of the trading and the managing that I've done with my covered call trade, starting from the top arrow where I bought the 200 shares of steel at $11.97, and then I sold two $12 calls, took in 28 cents, and then the amount is over on the right. And then here, the next arrow down, I bought those back for 80 cents, 168, and then sold some more for 254.46. Took in a credit of about $80, $82, whatever. And then if we go all the way down to the next arrow, yes, you are not seeing things. I was able to buy those back for $8, right? So I made all that money, 254 minus 8, and then I sold some 11s, took in 216.67, and these are all very short term. Those ones expire the 15th, and then I bought them back for 129 on the 16th, and then I waited, and then I sold to open them for 152.67, same strike price. And then at the very bottom is when everything flew off the handle and still went up all the way from like 11 whatever it was that day all the way up to where you see it is now. And if you take all of the green numbers, add them up, and then you take all of the red numbers, add those up, and then you subtract the red total from the green total, you will find that I made a total of $153.02 profit, and that would have been on my $2,401.95 investment. And I believe I did the math earlier. The return on that particular trade would have been about 6.5%, which is pretty good for the 2 months. Now, it is worth noting that had I would have just bought the shares at $11.97 and not sold any covered calls, and then sold the shares at $13.37, I would have made more money. I would have made the, let's see, 1337 minus 1197, I would have made $140 a share times 2. I would have made $280 versus the $153. But the thing about that is, had I would have bought the 200 shares at $11.97, there were times when steel was all the way down to $10. So there would have been moments where the volatility would have been increased, and would I have the emotional tenacity to stick it out and hold all that time? So that's why we all choose different option strategies or investing strategies, whatever suits our personality. I'm not so sure that I would have had it in me to hold on to the shares of steel and made that more money. So I'm perfectly happy making a 6.7% return, and I don't cry, oh golly gee, I wish I would have made more, I wish I would have done better. But I do go back over my trades and my transactions, and I find out, what if I would have did this? What if I would have did this different? And sure enough, I could have just bought the shares at $11.97, held them, not selling any cover calls, sold the shares at $13.37. I would have made more money. Now, how do you know when is it time to close your cover call trade and get out and take your profit? And the answer is right here at the bottom. Okay, right here at the bottom, notice that I paid $2.42 for those $11 calls. And then I sold the 200 shares for $13.37. So the way you figure it is you take the $11 strike price and you add the 242, and you get 11 plus 242 equals $13.42. Now the shares are at $13.37. That's only a $5 difference. Okay, so if I would have kept holding on to them, the most money that I would have made between now and when they expire November the 15th would have been an extra $5 a contract. So I could have made an extra $10 per contract. So it wouldn't make sense for me to hold on to the shares all that extra time just to make the $10. I might as well get out, take my profit, and do something else with my money. And so that's what I did. I got out. And so the way you know when it's time to get out of your covered call trade is when there is no time value left in the call. And that's what happens when a stock blows past the strike price of the calls you're selling. The time value goes poof, and then you say, okay, time to get out, because it would make no sense to hold on to this, 242, 11 plus 242, 1342, 1337, hardly no time value left. That's when you know it's time to get out. Now, let's go back to my account. If there is time value left, like let's say I would have been a little bit more aggressive and I would have sold some of the higher strike prices, I would have made more money. And let's take a look at some of the higher calls for steel, and I'll show you what I mean. Let's look at the $13 call. So here's the $13 call right here, and this is for November the 15th, which is when the $11 calls. And if I go to in the money, I'll show you. So there it is right there, 224, 227. And actually the premium's different because after I sold out of those covered calls, the price dropped. So the premium's not the same. But let me go back to the at the monies here. Near the money. There you go. Okay. Now let's look at the $13 call. Now if you take the bid is 61, the ask is 63. So you add, let's say 62, you get $13.62. Okay. Now we got a lot more time value. So I would not be so inclined to get out of that trade. I might hold on just to make, because now the time value is not the $5 that you saw earlier. Now the time value is $13.62 minus $13.21. We're looking at 41 cents. So you could make another $81 times 2. If you're selling 2 of them, you can make another $160. That might be worth it to hang on to, right? But it's really up to you when you want to get out. Now, let's say you would have sold some of these 1350s. Well, the 1350s, I mean, actually those would have even went up in value, right? But you would have made so much money in your shares, and that's the thing. The more out of the money call strike prices that you sell, the more money that you could make, but the more risk you're taking, because if the stock goes back down, you can see these 1350s are going for, let's say, $38. Well, what if steel goes back down to $12? Okay, you own 100 shares. Well, steel's at $13.21. You're going to lose $121, but you're only going to make $38. But if you had this $12 call, then the bid is $132, the ask is $137. You'd make $135. You'd lose $138. You'd only take a $3 loss. So that's one of the things to know about covered calls, is the more out of the money strikes you sell, the more money you could make, but the more risk you're taking. The more in the money, the less risky and the less profit. But that's basically the main way that you know when it's time to get out of the trade, is when you see something like this at the bottom, 242 plus 11, 1342, and then the shares are at 1337. There's only $5 left in the trade. It's time to get out. It's time to take the profit, and then you have all this money that you can do something else with. And I'll close the video on this. After I got out of that trade, let me go to my transactions. Actually, let me go to my position here. Now my position, I no longer have 400 shares. Now I just have 200 shares, and I have 2 call options, $15 strike price. I still have my 6 put options, and I have 2 short calls. But I want to focus on these two calls here. Now let me go to my transactions and let me show you what I did. So right here, after I got out, I sold the 200 shares. There you see it right there. And then those are the calls that I bought back. Notice I also sold to open two more $15 calls at 41 cents a contract. And the reason why I chose $15, those expire in about a month. Those are expiration December 20th. That's in about a month and a half, I guess, 48 days or whatever. And the reason why I chose $15 strike prices is because my position, I'm holding $15 calls. So it still does go to $15 and it goes higher. Then I will start making money on these calls, and I will make money on these 200 shares that I own up here. So, and if it doesn't go up there and if it goes back down, well, I sold out of my covered calls. If it goes below 11, if it goes back down to the $10 levels, then I have these 6 put options that are hedging me, and I'm out of my covered call trade, so I will take no losses on that. I took my profit, I banked it, I made the profit, and I have a brand new position that I'm working with, continuing to manage my money all on one stock. I am not a diversifier. I don't believe in diversification. Not that diversifying is bad, but for me, it's taxing enough emotionally for me to try to manage one position. I don't want to try to manage multiple positions and diversifying. And so that's what I'm doing right now. I sold these 15s. I feel totally safe and secure no matter which way it goes. And actually, if you look here, my short calls, the bid is 35, the ask is 38, and if we go to my transactions on those calls, I got, what did I get? Where are they at? Right there, 41. So I'm actually already up like, what, $4 or something. I've already made like a little tiny teensy bit on that, you know. Of course, that's all doesn't, you know, meaningless, doesn't matter, but that's what I'm doing right now. Going back to my positions here, and that's pretty much it for my video here. But again, the finisher of my video is when there's no time value left in the calls, it's time to get out. If there's only $5 left in the calls, it's time to get out. And steel charts are looking pretty good here. This is the chart right here, and this is a 1-year chart, and the chart here, it has been downtrending, and for the first time it looks like it's hitting back into resistance, and it may even break through the resistance. And if I clear this out and I look at a 6-month chart, it's more pronounced, and it is very clear to see that resistance was broken a little bit, which is the first time in a very long time that that's happened. And if we go even lower, and this is the point that I want to make, I think the key level to keep an eye on if you're going to load up on steel is this level right here, about $12.50. And we'll see what steel does next week. But if steel drops back down and it goes below $12.50, then I would wait before loading up on shares of steel. But if it goes back down and then it bounces up and it does not break below $12.50, and it even better, if it breaks above the current resistance, then that's a pretty darn good sign that the tide is changing, and you can use this $12.50 as a good level of support to sell to open some put options if you are an option seller. So that's it for this video. Thank you for watching. As always, if you have any comments or questions, feel free to ask. And until the next video, thank you for watching. Have a good day. I will see you in the next video. Ciao.